Hey there, everyone. Welcome to Chart This with Dave Keller, and happy Tuesday, May 13th. I'm your host, Dave Keller, and coming to you from a beautifully overcast and quite green Redmond, Washington. Hope you guys are all doing well. Saw the news that the Hall of Fame ban lifted on Pete Rose and Shoeless Joe Jackson. That's news. Talk about a nice, fun headline to see. I think we should all go watch Field of Dreams in celebration of this momentous occasion. The market's fairly resilient today. The Dow, not particularly strong. The Dow actually lower by about 1/3%. That's weighed down by some of the names struggling in this new world that we've established here this week. But on the S&P and the NASDAQ, further upside. As we've talked about many times, right? You think of the markets like a stoplight. And I would say we spend way too much time trying to pinpoint peaks and pinpoint lows and celebrate people that kind of time it perfectly. I'd love to be great with that, as always. However, reality is you have to analyze the charts, gather the evidence, and make the calls, make the position based on the weight of the evidence. I think the weight of the evidence has changed here in the last month from remarkably bearish to remarkably neutral, and now arguably remarkably bullish. And I would say that every day we spend above the 200-day moving average at least reminds you that the position of the market is in strength. As always, though, if I'm positioned long in any chart, I'm always looking for signs to turn bearish, right? I'm looking for the chart to tell me I'm wrong. If I'm all bared up, I look for signs for the market to tell me I'm wrong. And I think having a humility when you approach these markets is always important. 2025 is no different from any others. I would tell you that I think the breadth conditions have improved to the point where the likelihood of sustained gains is definitely there. And I would say now it's all about holding support, right? And so I think the 200-day moving average, probably more important than ever. Sometimes we don't talk a lot about the 200-day. This is not one of those times. I may mention it many times in today's episode. Further strength in some key areas in the market. Solar stocks ripping to the upside, sort of joining the Magnificent Seven and other growth names moving higher. Regulatory changes that could have been much more negative for solar coming in a little stronger. So First Solar, the top performer in the S&P 500, joined by some other growth names and a bunch of other things on the gainers list for the day. With that in mind, let's get to the market recap and focus on how things played out today. This week, we've been charting literally the S&P 500 regaining its 200-day. Yesterday is sort of an everything up day. Today, on Tuesday, May 13th, kind of mixed, but generally more stocks up than down, as you'll see from today's advanced decline data. The S&P 500 up by about 0.7%. That brings it close to 5887. The NASDAQ composite over 19,000 after today's gain, up about 1.6%. The NASDAQ 100 right about the same. The Dow, though, down by about 0.6%. We'll look in a minute about why that actually was such a dispersion or such a differentiation between stocks up and stocks down. Mid caps and small caps both gaining here. The S&P small cap up 0.5%. The VIX continuing to drift lower, not by much though. This was not a big lower vol kind of day. Down about 0.17%. That's not much in VIX terms. However, the VIX below 20 every day that's the case, I think reminds you we're now in a low volatility environment. This is a traditional bull market range for the VIX. And again, what would tell you things are different? What would tell you you need to be a lot less optimistic? The VIX popping above 20 is one of those basic things I would be looking for, along with the S&P above its 200-day breadth indicators that have been very strong, starting to turn lower. All of those things should give us a clear signal that this uptrend phase is over. But for now, you're certainly seeing quite a bit of strength today. Where you're not seeing strength is the bond markets. The trend this week here and now recently has been a rotation away from bonds into stocks. There's a lot of reason, and when something like interest rates go higher, there are a lot of things we can infer. There are a lot of reasons why we could speculate as to why that's happening, which you have to remember, there's never one reason, right? As much as we want to boil it down to the 10-year yield is up because of X, Y, Z and have it just be that one reason, and it's very simple. You have to remember the markets are a complex mechanism. So there are a number of things that can cause a change in the dollar, change in rates. Day in, day out, there can be a lot of moving parts that sort of aggregate into rates changing. But we can start to identify some general themes and sort of speculate as to what's sort of the broader macro forces at work. I would say in this case, you're seeing risk assets push higher. You're seeing more of a risk on positioning with defensive sectors lagging and offensive sectors rotating higher. We'd seen the beginnings of that, but now we're really seeing an acceleration in that trend. And that means investors that had gone to the relative safety of the 10-year bond, for example, now kind of rotating out of bonds and back into stocks is how I would generally say it. So the 10-year yield moving higher to about 4.5%, the long bond yield around 4.94, the 5-year point around 4.1%, and bond prices moving lower today with the TLT, which is a Treasury bond ETF, down about 0.4%. The dollar, by the way, the UUP was down about a quarter. That's 0.9% from yesterday's close. So weaker dollar, weaker bonds, stronger stocks. Stronger commodities as well, with some exceptions like natural gas, which drifted lower, gold and silver back higher. So again, as much as we always think gold and stocks should move inversely, they don't always. There are times when gold serves as a safe haven. There are other times when both of them move higher, which is what we're seeing today. The GLD up about 0.4%, silver prices, copper prices, crude oil prices moving to the upside. You'll note when we look at the sectors here in a moment, the technology sector was followed by the energy sector as the top two performers in today's session. Cryptocurrencies back to looking a little bit better yesterday, and what we've seen recently as stocks rotating higher. Crypto's kind of led higher out of the April low, stalled out a bit. Bitcoin back rotating higher over the last 24 hours. Bitcoin currently around 104,450. Ether prices around 2680. Those are both up a pretty good amount today. Ether prices up over 7% today. Solana up 5%. All of the top 10 coins tracked on the stock charts platform in the green today. All right, looking at the 11 S&P sectors, you can see it was actually quite mixed. While the S&P and the NASDAQ were, sort of strong up day, other areas of the market, not so much. And you'll see the areas that were hit the most, some regulatory, changes. And again, what you have to remember with equities, there's an upside, right? The idea of what's called the equity risk premium is basically you're taking on additional risk, owning stocks, and as a result, you have the potential for greater returns. So if you want no great returns and you want no great risk, you buy treasury bonds and you just kind of go and do something else with your life, and you're going to have some, slow and steady gains, most likely over multiple cycles. But if you want more active gains and more active bets, then you take on risk by owning ETFs or individual stocks for the potential to own greater returns. So what happens is those risks are real, right? And so those risks can hit. One of those risks you have from earnings or from equities or earnings risk, right? Earnings come out worse than expected or don't beat estimates. Guidance is lowered, something related to earnings. You have volatility risk where the market just sort of moves. And so the volatility of the assets that you hold create additional potential for loss. And regulatory risk, which is the government decides to make some change to some law or something that causes your equities to be no longer as maybe valuable as they were yesterday. That's what's hitting healthcare with the latest announcements with pharmaceutical costs, which is probably going to hit their bottom line pretty aggressively, as the market is telling you. You're seeing that with some renewable energy names like Enphase Energy, Plug Power, getting crushed pretty good today. Some of the worst performers out of the major averages that we'll track here. So today, kind of mixed results as different companies are benefiting from or struggling from some of that news flow. At the top of the list, you have the technology sector, the XLK continuing to outperform here, up another 2.2%. That is dramatically outperforming the S&P today. Energy number two, as crude oil prices go higher, energy stocks are doing okay as well, up 1.4%. Consumer discretionary, led by Amazon, led by Tesla for sure, the second biggest name in the XLY, doing quite well today, up 1.3%. On the downside, you can see 5 out of the 11 S&P sectors are in the red. The healthcare sector, the XLV, down another 3%. That continues to be an area where we would be avoiding like the plague, for lack of a better term, because the charts don't look good. And the charts in some cases have not looked good for a while. In some cases, they had looked pretty encouraging, but the ones that had looked encouraging are certainly starting to look a lot more vulnerable here. So the XLV down 3%, consumer staples sector, which has been a pretty interesting place to be, going into that April low, continuing to struggle on the way out. Consumer staples and REITs both down about 1.33% from yesterday's close. Just want to mention a couple things here in terms of breadth. I mean, not as great as you might expect, particularly depending on what area of the market that you're looking at. The New York Stock Exchange breadth, which is a broad universe, that's probably the most important advanced decline line that I watch, up about a 2-to-1 ratio of stocks advancing versus declining, about 60% up, 40% down. On the S&P 500, actually more stocks down than up, although it was essentially flat, about a coin flip between stocks higher or lower. Small caps even had pretty strong breadth, with 62% of small cap issues up. So again, if you look at the S&P 500, the breadth is not as encouraging. Let's look at the Dow, which is actually down today. So Dow members, you've got Nvidia up 5.6%, Caterpillar, Boeing, Goldman Sachs all up over 2%. But look at the things that were down. So again, it's the regulatory pressure that's killing the Dow right now. We have four Dow members, in healthcare that are at the bottom of the list today. From United Healthcare, down 18%. They keep this up, watch them get removed from the Dow. That's one of those things you have to remember about indexes like the S&P, the Dow 30, the Russell 1000, the NASDAQ 100. These are not static lists of stocks. Those lists can change. So when you look at like a long history of the Dow or the S&P, the members of those indexes change, and it's very subjective. It's the people at Dow Jones or at Standard & Poor's that make a subjective call of, we're taking these two stocks out and we're adding these two other stocks back into it. At the Fidelity chart room, when I ran that department back 2008 to 2016, we had this fantastic chart, this wall of the Dow members, and it would show the constituents of the Dow from the inception of the Dow Jones Industrial Average to the present day. And it was always funny to note that, I mean, literally none of the original Dow members in anywhere near their current form were in the current Dow 30, and that had changed many, many times. So thinking of the long history of the Dow, we think of it as this group of stocks telling the story of market history. It really is a rapidly changing group of stocks. Gradually changing is probably more fair, but it's a fluid list. So my point of saying that is a stock like United Healthcare looks bad for long enough, and it magically is no longer in the Dow, and they'll swap it in with the thing that's starting to do well. This is how something like, Palantir ends up in the Dow, is because, names like healthcare names struggle. And so they start to rotate those out and add something that's newer and fresher and performing actually quite well. So there's a survivorship bias definitely there in the indexes. But that's why the Dow is essentially down. It's a lot of the healthcare names and others that are dragging that price-weighted index to the downside today. Looking at the Magnificent Seven and Friends, these leading growth names, we can see NVIDIA having the strongest day, up 5.6%. I mean, the chart of NVIDIA reminds me of the chart of Broadcom. A lot of semiconductors having some really nice uptrends, trend lines off of those lows. I think pretty important to track because we can see how quickly, how aggressively that those stocks have recovered. And I think equally as aggressively they can pull back. So watching those trend lines for breaks can be a pretty good way to lock in gains and avoid giving back all those gains when the market turns lower. It won't be if, but it'll be when. At some point, prices become high enough that they start to rotate lower. Tesla up another 5% today. Broadcom, as I mentioned, another one with an aggressive vertical move off of the lows, up another 5% as well. Netflix actually back higher today. It was down yesterday. It was probably the best chart of this group in terms of recently testing new all-time highs, but bouncing back up 2.5% today. Microsoft flat for the day. They had news that they were firing 3% of the global workforce, I want to say, which is, again, I mean, relative to the overall size of Microsoft, is not a huge number. But if you're one of those 3%, I'm sure that's a pretty tough news to get. However, Microsoft differentiating itself with reducing a little reduction in force today, while other things moving to the upside. As you'll see, I mean, when we talk about something like this current market environment and how the evidence has changed so much in the last month. Again, a break of the 200-day, I think, is pretty meaningful. That's what did not happen at some of these previous swings. Holding that level, I can't tell you how important I think that is, because many like me are starting to respect the uptrend that we've seen and recognize the strength in momentum and breadth. But those signals will change, and that evidence will evolve to more negative signals at some point. Watching the charts diligently, keeping on top of them with a consistent routine, that's the game. Hopefully, this show is part of your own routine of tracking that changing evidence. We'll bring up the market carpet here as we do. Just want to let you know our latest episode of the Market Misbehavior podcast with Urian Timmer was released yesterday. Might have been this morning, actually. It's a bit of a blur. I used to work with Urian. If you follow his work on social media, he gives away a lot of fantastic charts and insights every day on his X account, also on LinkedIn. I used to sit 3 offices down from Urian in my Fidelity days at one point, and I followed his work for a number of years. It was a lot of fun to chat with him about the environment, about valuations, about the Trump put, about how to make sense of 2025, a lot of other things. Hopefully that is one of many conversations I have with Urian on the podcast, but I would encourage you to check that out on our YouTube channel. Most recent episode, not quite ready for you, hopefully tomorrow morning, with Nick Raish. And if you don't know Nick is the founder and CEO of a firm called the Earnings Scout, based in Northeast Ohio. We met through a mutual friend years ago, and Nick is a fantastic earnings analyst. So we talked about Q1 earnings season, sort of lessons learned and key takeaways. We talked about earnings estimates, and he has a really compelling way of looking at it that I think you'll find interesting as well. So if you've followed earnings or have struggled to follow earnings, Nick's interview, I think, hopefully will help you identify some of the key things you should be looking for. So latest episodes of the Market Misbehavior podcast for your enjoyment. Check them out on our YouTube channel. All right, let's look at the market carpet here. I mean, a decidedly mixed day, right? This is not a everything up kind of day. This was a lot more mixed, actually. You saw the S&P breadth was basically, almost a coin flip between up and down, and that's how this feels right here. Some themes, though, that we can identify. Number one, in the upper left, obviously the strength in technology. Microsoft, an outlier, being flat today. Salesforce, Cisco, other names that are flat, but the rest of the technology sector, with the exception of Enphase Energy, which is arguably a very different company than most of the others, doing quite well today. NVIDIA, Broadcom, Oracle, Palantir, semiconductors, a bunch of other things, obviously having really good days today. Western Digital, the hard drive makers like Seagate up another 5+%. So technology continues to be a space where we've seen strength and we continue to see strength. I think that's an area where you obviously want to be focused if you're looking for strong momentum names. The energy sector having a pretty decent update here. We've been, arguing against energy generally because of crude oil prices not really coming in, maybe making a double bottom though, and you're seeing a rotation higher in crude oil prices, which means names like Apache and others are bouncing off of their own lows. They're not having the uptrends off of the lows like you're seeing in technology, but for energy, pretty impressive moves off the lows. A lot of these names are still below their 200-day moving average. I'm still seeing better charts elsewhere, but if you've been totally ignoring an underweight energy, and I think for a good reason, those good reasons may be starting to change a little bit, an area to look at. Healthcare, obviously, bright red. REITs, consumer staples, utilities, some of the more defensive sectors, all getting beaten down. We grabbed a chart of the relative performance of those defensive sectors, and I think that tells a pretty important story about the rotation from offense to defense, and now the rotation from defense back to offense. And I think that's certainly a trend to continue to watch. Finally, again, the communication services sector is an interesting one to watch because it has some kind of new communications and old communications, right? You've got names like Meta, Netflix, Alphabet, more internet names. You also have old school telecoms and mobile names like AT&T, Verizon, T-Mobile. You've got media names like Fox and Disney. It's a whole mishmash of interesting things. And today it's sort of the offense over defense, right? Defense would be things like AT&T and Verizon, the old school telecom names, divergences that we saw going into the April peak. starting to manifest themselves with a pullback of sorts. And the newer names, names like Meta, Netflix, doing quite well here. It's interesting to note as you look at all this green in the growth space, some of these stocks still kind of left behind. I would argue Alphabet, not a great chart yet. Apple, not a great chart yet. These are the names that are, sort of lagging behind the rest of the Magnificent Seven. Tesla for a while was that negative outlier, kind of the dog of the Magnificent Seven, just struggling to perform anywhere near where we saw the others. That's starting to change. Tesla, arguably one of the more encouraging charts that we've seen here in the last couple of weeks, while Alphabet and Apple are the two lagging behind in a pretty big way. All right, let's continue on looking at some charts. Here's my daily chart of the S&P 500. Again, I update this chart when I feel like there's something that needs updating. And I always tell people, treat your chart of the S&P 500. My advice, treat the chart of the S&P 500 like an ongoing conversation you have with the markets. I would have a chart of the S&P. You don't have to ever share it with another human being, but have it on a platform like Stock Charts or Optima or somewhere where you can save charts and refer back to them and keep notes on there, draw lines, draw things. I'll never forget one of my analysts at Fidelity, Mark Dibble, who's now, he's probably been there 35 years, I want to say, probably would be my guess, Mark. Maybe a little longer. But Mark's a fantastic technical analyst. And I remember the first time I sat down with him after joining Fidelity, and his charts had all these lines on them. I'm like, what are you doing? And he said, this is every day I'm updating these lines. I'm drawing things that are important to me. He'd print them out and make notes on them. And it was a great reminder of the value of technical analysis to help you just understand the markets and don't miss the opportunity. Don't lose that opportunity to capture your thinking, to capture ideas and refer back to those. That's one of the ways I use this show, actually, is I'll go back at the February peak and I'll look at what was I saying in mid-February? Was I seeing signs that things were overheated? What did I miss? Right, looking back, what are some of the things that I should have looked at? Going into the April low, what evidence was I looking at? What evidence did I miss? What evidence did I maybe overthink? And using that as a way to improve your game, I think, is a really good way to approach this. So the reason I mention this because I have made some changes here just on the notations to highlight the fact that I think the 200-day has become a key point of reference here. We always talk about pivot points, right? A level that is sort of like a magnet for the chart, a level that has meaning, a level we often refer back to. This level we're looking at is the gap range that we basically created this week. Here was last Thursday's high, just above 5,700. Here was Monday's low around 57, we'll call it 5780. And I think that gap, which we've now highlighted in red, which encompasses the 200-day moving average, also encompasses basically that swing high from March, which was the previous attempt to break above the 200-day. That's all right about there. And I would say generally, we stay above that shaded area, things are pretty good. And I don't mind betting on further upside and taking some more aggressive bets to follow this trend higher. If and when we break below that, though, all bets are off. And I think you have to get more defensive and assume we're going down to deteriorate. Now, there could be headlines that create this. It could be valuations. It could be the fact that we've just rallied so significantly that people start taking profits. I don't know what would cause that rotation lower given what we've seen so far, but I do know from a technical perspective, holding that level is pretty valuable. So we'll keep an eye there. I think yesterday's gap higher and today's follow through to the upside just confirms to me, think bullish and use the 200-day as a stop for now is a good way to plan things on the tactical side. And the good news is I'm not struggling to find names that are looking pretty constructive right about now. Now, I mentioned breadth pretty regularly. It's, as you probably know, a key part of my process because for me, it helps you sort of look the next level down. And once you analyze the chart of the S&P, what can we learn by looking at all the individual stocks that make up these major indexes? So this is a series of indicators that I just call the chart, something I have on my main chart list and something that I look at every single day as just a gut check on where are we at with these key levels that help me determine whether to be risk on or risk off. The S&P 500, of course, making a new swing high, getting above 5750 on a closing basis. That's pretty encouraging. I don't have the 200-day on here, but obviously that's pretty important as well. The advanced decline line on the New York Stock Exchange is getting very close to a new all-time high. And while the S&P is still well below its February peak, the advanced decline line is getting very close to its own November of 2024 peak. I think famously, the S&P made a new high in February of this year on weaker breadth readings, right? And we covered that, I think, pretty heavily on the show. And I think that was a key sign of a potential market top. Now we're actually seeing the opposite, where breadth is actually outperforming the S&P almost. And that should be a very encouraging sign. If the advanced decline line on the New York Stock Exchange makes a new all-time high, I don't think that's anything but bullish. And you're seeing that already with the S&P's advanced decline line already making a new all-time high. All right, stocks above the 50-day moving average. I actually wrote about that earlier today on the Stock Charts platform. So if you go to stockcharts.com, click on articles, you can read my latest post on that particular breadth indicator. We focus a little bit more on the percent of stocks above their 200-day and previous occurrences where we've seen the surge that we've observed here over the last 4 weeks. Pretty bullish, to be honest with you. But the percent of stocks above their 50-day moving average getting close to 70%. Close to 75%. We were just above 70% yesterday. If you look back to the left, the last time we were up in this general range was in November of last year, and before that, you have to go back to September, October. Again, not always perfect, but when so many stocks are above their 50-day, you start to look for signs of a pullback at some sort. We're not quite to that level. We are to that level with the bullish percent index, which is pushed above 70%, which is what I consider the overbought threshold. And again, not a perfect indicator, but when I see the indicators get the breadth indicators get to that extreme high level, it tells me to look for a potential tactical pullback at least. So something to keep an eye on. Now, offense over defense has rotated dramatically from making a new 3-month low in mid-April to now a new 2-month high today. We're seeing offense outperform defense in the form of consumer discretionary over consumer staples. I have a number of other ratios that I track to look at offense over defense, and pretty much all of them are favoring offense over defense here in the last month. So again, the defensive positioning, the defensive sentiment that we saw in the first quarter into the second quarter, now being alleviated, and we're seeing the evidence point more positive. Here's the chart of the percent of stocks above their 50-day, and I'll show you the specific thing that we looked at. What happened here is the indicator, and this is percent of stocks above their 200-day moving average. It got down to around 20% and now is above 50%. That particular move of going below 25% and back above 50% has happened 8 times since the 2009 market low. So since the great financial crisis, that has happened exactly 8 times where we've gone below 25% and then back above 50%. In 7 of those 8 times, the market was higher for the next 6 months and for the next 12 months. Only one time did we make a retest the previous swing low, and that was in 2015. And what happened in 2015 was we failed to hold the 200-day moving average. And all those other instances, we held the 200-day after that surge in breadth, and that told us sunny skies going forward, which again reinforces for me watching the 200-day, because if we break the 200-day, all of a sudden this looks a lot less like those 7 occurrences, and it looks like the one occurrence where we failed to hold support and the breadth immediately turned lower and told us we had another leg to the downside. Here's the relative performance of some of the defensive sectors. This is something that I watch very closely in terms of sector allocations and just thinking about what's working and what's not. I think this is one of the key parts of market awareness, or what I call situational awareness, with my market misbehavior premium members, focusing on sectors that are working and sectors that are not. Technology is working. These defensive sectors are not working. This is the relative performance from the top of utilities, healthcare, consumer staples, and real estate. It's not just healthcare that's underperforming, although that's definitely the worst here in the last month. You can see utilities, consumer staples, and REITs all rolling over. Now, all of these sectors were outperforming in 2025 going into the April market peak, or the April market low, that is, the peak in relative performance here. From the April lows, we've seen the relative strength rotate lower, and that really speaks to the fact that investors have gone more risk on enough, or to enough of a degree, that we're seeing the major benchmarks move higher. Here's the MAGS ETF today, continuing higher. Now, yesterday we mentioned with at least one name, and I forget which stock we were talking about, with the hanging man candle. That's where you have an uptrend. You have the open and close near the highs of the day and a long lower shadow. That's actually a short-term reversal candle. But today, ignoring that completely, making a new high above a 61.8% retracement. So you take the December peak and the April low, 61.8% of the way up. It's right at $51. We broke above there today. As long as that holds, this is a chart going onward and ever upward, as we like to say. NVIDIA finally recovering its 200-day moving average. One of the things we've talked about here from the April low is that most of the Magnificent Seven stocks were below their 200-day moving average. That's not good. One by one, you saw Meta gap above the 200-day. Today, you get NVIDIA gapping above the 200-day. We've seen Tesla break above the 200-day. Just in the last couple of weeks, we've seen a big rotation with those leading growth names following through above that moving average resistance. And so I think every name like NVIDIA that does that gives further weight to the bull case. Watching that trend line, we showed that trend line on Broadcom's chart, I think yesterday. I would keep an eye on trend lines off of the major lows. That's a great way to sort of, seeing the downside risk within this uptrend. That still means the medium-term trend can be bullish, but gives you some short-term pullbacks or an idea of where that could go to. Now, it's not just NVIDIA. Obviously, the broad semiconductors rotating higher. The SMH gapped above its 200-day moving average yesterday, following through to the upside. I think today was key. Yesterday was the big move, but today is the after party, right? Today's the follow-through day. If today had traded lower, I would say big question mark on Monday's breakout, because it tells you people were taking profits. I'm not seeing profit taking. I'm seeing people step on the accelerator, not step on the brake today. Tesla has broken above its 200-day moving average. That break above 295 was pretty important. We've now seen a follow-through above the first Fibonacci resistance level, which is around 320. For me, that opens up the way to 385, which would be another, 50 points above today's close. So again, strong charts tend to get stronger. Keep an eye on those trailing stops and risk levels. But overall, Tesla in pretty good shape. Overbought as of today's close, something to watch. I saw some news about Enphase Energy and Plug Power. These are two names getting hit with the regulatory bat, as it were. Both of these charts, however, I would say have been in clear downtrend phases. So if you own an Enphase or a Plug at this point, at some point you miss some clear technical deterioration. I was taught prices go down for a reason. I was taught as much as you want to buy things at the lows, it's much better to wait for the chart to improve enough and tell you that it deserves a place in your portfolio. So Enphase and Plug Power down on regulatory news. I would say the charts have been telling you these are underwhelming charts in primary downtrends for quite some time. Both of these below downward sloping moving averages continuing to this day. Now, First Solar is one of those that's actually shown some improvement, right? We were consolidating on the chart of First Solar for the last couple months, right? From March, April, we sort of settled into this range, 140, call it 115 or 120 on the lower end. We broke above there on Friday. Yesterday, we didn't really gap higher, but we did continue to push above that level. I think that clears the way out of that basing pattern. Today, we gap above the 200-day. We gap above that 38.2% retracement level. Holding that is pretty key. So I'm watching 189 on that on today's breakout. We'll see if we get follow through. For now, a lot of question marks in renewable energy kind of solar spaces, given the administration that we have. But for now, holding in okay. This is the weekly chart of Johnson & Johnson. Johnson & Johnson going down today, along with a lot of other pharmaceutical names, given the regulatory headlines on basically aggressive changes to their business model is how I would generally describe what I've heard on the issue. The weekly chart of Johnson & Johnson, though, has been an underwhelming chart for quite some time, right? If you look, the chart of Johnny John has been more of a trade than an investment, right? A trade, in the way when I say that, I mean a trade is it has cyclical patterns, it has moves, and if you can identify swings and bet on that mean reversion, you probably have plenty of ways to make money in that sort of tape. But if you're a long-term investor, this is basically not a great place to be, because there's just a lack of directional move, right? You can go up, you can go down, you can go sideways, and the weekly chart has been dead sideways. So the action, the movement has been on the shorter term time frames. This is one of those long-term stories that it's not a great place to be, and I would much rather look for opportunities elsewhere. On the short-term basis, on a tactical basis, if you have the right set of indicators, playing those swings could actually be quite profitable. It's not the time frame we often talk about, but something certainly to pay attention to. Keep a watchful eye on AT&T and others. These are names that have done quite well year to date. However, are starting to rotate lower as investors are rotating back to some of the growth names that have been struggling for quite some time. The chart of AT&T featuring a big bearish divergence going into the April peak. Not lost on me that you have that big bearish divergence in AT&T as you have the S&P making what we now learned was apparently a very significant low in early April. So the divergences in the leading names, a great warning sign of maybe a change of leadership. For now, we've basically retested the previous peak and stalled out here. It's not a horrible chart yet. And I would say, again, the momentum is still okay. The RSI is holding 40. But the fact that it's starting to pull back after a failed attempt to break higher tells you at least we're in a different phase and in a sideways trade for now. Bank of America, ticker BAC, one of the many financial stocks having nice recoveries. A lot of the financial stocks look kind of like this. Again, there's so many charts gapping above the 200-day. And for now, I think it's a pretty straightforward chart, right? We hold that 200-day on pullbacks. It's noise, it's fluff, it's just movement, normal movement. We break the 200-day. I think you have to bring this gap higher in question. But for now, charts like this holding their breakout levels. All right, let's get to some questions. Those are the charts that I wanted to review. I appreciate all the questions that came in. Boy, I'm not going to be able to get to all of these, but I will definitely add them to our mailbag and get to as many as I can here. Let's get to a couple of these. David, I love this. Let's talk about it. In my opinion, 200-day strategies are not useful. By the time you break it either way, you've missed the bigger move. Don't even bother trade with that simple method. Just stay invested 100%, and you will be cut off on the chat, apparently. No, hey, listen, I appreciate it, and I will tell you, I have no problem with people questioning things that I show. One of my favorite books that I read, to be honest with you, in my career was A Random Walk Down Wall Street, which literally, this is a book, this is a treatise on what I've built my career around, why it doesn't work or why it shouldn't work. It was all about how, the random walk theory and stock movements are random and it's not a good idea to follow it. I don't agree with a lot of what I read, but it certainly made me challenge my own thinking and challenge my own theses. I mean, investing is not boring. And if you feel like you have a really good approach, you will find someone that tells you your approach is absolute garbage. I think that's what makes this so interesting and so fun. So I appreciate your feedback. When people tell me when you wait for the 200-day, you're too late, it's a question of time frame, right? And I think that's what you have to remember. There are plenty of things you can use to make this trade on Bank of America from the low up to the 200-day. That's a time frame a little lower than what I often look at. And one of the things, as I'm probably licking my wounds and debriefing on my own analysis of 2025, I guarantee I will focus a lot on this low in April because I've been fighting this for quite some time. No shame in telling you that. I think that's absolutely right. And what it reminds me is at major lows, and I've gone through a lot of major lows in my career, assuming that does end up being one, time becomes very compressed, and you have to adapt your time frame appropriately. Short-term indicators certainly turned very bullish very quickly. It's the medium-term indicators that have taken so long to rotate. And I can't guarantee we don't absolutely tank tomorrow. I don't know what's going to happen tomorrow as much as you don't. But I do know that looking at those major turns and reflecting after the fact on how the evidence shifted, what you followed, what you didn't, that's how you become a better investor. And as I've mentioned many times in, previously in 2025 and in previous years, I've learned more from bear markets than bull markets. My toolkit doesn't get a lot better in a bull market because things are very easy. In bear markets is where you learn where there's some potential weaknesses. I think I'll certainly be looking at this period, and I'll share my lessons learned as always. Brian, thanks for watching on YouTube. I think your old line in the sand was 58.50. Does this now become an upside line in the sand? Maybe. And I was actually looking at that earlier. I appreciate you asking about it. Looking at the daily chart of the S&P, 58.50 was this line from back here. And this was a key pivot point on the way down. I'm thinking of that less and less only because, and I feel like when you look at a chart, I always tell people you read from right to left. If you read from left to right, 58.50 probably is very important. And that's how things played out back in the second half of last year into the beginning of this year. And I think that breakdown here was a pretty important milestone. At this point, though, I don't know how much 58.50 is the level anymore. I mean, I think this most recent gap becomes like the crucial moment, right? I mean, so reading right to left, that to me is way more important than the levels we have back here. Having said that, every level like 58.50 we get above, it's probably more of a secondary level, I guess, at this point. It's not a bad thing. But is it the primary way I would manage risk at this point? Probably not. All right, one more question. Jeremy, is anyone else seeing these giant bottom tails on the SPY at the close yesterday and at the open today? Seems like someone big is taking profit. I mean, there are so many movements right now, and I would say that the fluctuation across the board is absolutely fascinating. And I guess the one thing I would say is the last hour of trading. I actually didn't show the 5-day chart here, but let me bring it up. Because I didn't bring this up during the show. Here, I mean, we have another day. Yesterday was one of the first days we've seen in a while where we saw, a rally in the last half hour of trading. Today, we're kind of back to the market rotating lower. That generally would suggest to me those are institutions unwinding. Having said that, I mean, the general trend has certainly been positive. And we've seen that distribution. I think last week, this was a Thursday session. We saw a lot of that. Most of the days last week, you saw that roll over into the close. So certainly something to continue to watch. As we know, most of the volume happens in the first 30 minutes and the last 30 minutes. And again, people making some comments about everyone on one side of the boat. Thanks, Bull Bear Jeff, for that. I would agree. I mean, at this point, being bullish and following on the upside feels like a crowded trade to me. That tells me we can rotate lower very, very quickly. And again, we can guess when that might happen, or we can follow the charts and look for key levels. The 200-day, that 57.50 level, that's the level I'm watching right now. Folks, thanks so much for watching the show today. I appreciate it as always, and thanks for the thoughtful questions. I didn't get to all of these, but some really good questions I'll grab and pop into the mailbag. We're planning an all-mailbag episode on Friday. And I hope you can tune in and see some of those questions answers. But for now, I would say have a fantastic evening. And remember, it's always a good time to own good charts. Good night, folks.